Hello and welcome to BQ Prime, and you're watching BQ Conversation with the MD and CEO of TCS, Rajesh Gopinathan. Rajesh, thank you very much for joining us on BQ Prime. Let me begin with the demand question. Now, you've been answering it for a while. So, just to lay the foundation here of how the demand is looking um, as you look towards Q3 and Q4.
I think overall, sir, the demand is quite stable, right? And as we said, while we are not immune to the overall macro situation, and we're very cognizant of it and we're vigilant of it, on the ground we are seeing a very steady demand pipeline, and we are seeing customers committing themselves across the board to both transformation agendas as well as regular optimization agendas. So the demand is well distributed across industries, across markets, and even in markets which are slightly on the more watch list, like UK and Europe, we are seeing a fairly steady demand flow. So overall, we are quite confident about the situation. But as I said, we are not immune to the what's happening around us. So we are vigilant about it, but playing it one ball at a time.
You know, you're in a multi-service, transformational deals, right? And that's an advantage to you at some point because you are able to provide everything to the customer. What is the kind of transformation deals which you are seeing now compared to maybe a year or two back when these things picked up very pace?
That's a very important question, because what's shifting in the transformation deals or the overall digital transformation agenda, especially on the cloud side, is that a lot of the excitement and the front end activities has died down, and really the transformation programs are shifting to a more execution phase where complexity is much higher. And we are seeing the actual heavy lift, the actual issues of adopting a new technology change at an enterprise scale starting to come to the forefront. And that's an area of special strength for TCS. And that's why we are participating also significantly in these agendas as we engage with our customers. And I think this will define the demand environment for the next probably 12 to 18 months, that there'll be greater focus on execution, there'll be greater focus on rigor, there'll be greater focus on actually delivering a lot of what has been promised upfront. So the value of this digital transformation is real, but it needs to be actually realized, right? And for it to be realized, you need to go through the hard work of actually making those changes and doing it in the right way. And we are in that phase, which has opportunities of its own. And it also is not an easy place to be in for a wide variety of players. So we are in a good position, both from a competitive positioning as well as from a demand perspective.
Is that the reason why some of the deals are taking time to close? Because now you're going backwards into integration and core operations, and there the deal is taking time. If you say 6 months was the average, now it's taking 9 months to close.
I think, see, many times these headline deals, when you're in an expansionary environment, customers will also club together and try to get the best commercial value by clubbing volume together, and doing that in to put something big headline on the table. When you are in a more stable or a slight, maybe even with like where we are currently, that there is a hint of recessionary environment, customers also become more cautious of doing it. Now, it's actually not, one is not a better scenario than the other, because just because the deal is structured as a smaller one does not mean that the subsequent deal has the same level of competitive intensity. So in a transformation program, if the transformation program is bid out in its entirety, that is one thing. If only one leg of it is bid out, and if you execute it well, you position yourself quite strongly for the subsequent legs. So whether it got bid out together or bid out smaller is not a huge aspect of where it is. But it gives you less visibility. So you need to be a bit more risk taking on your own. And you should believe in that opportunity pipeline and in the way you build your talent and in the way you build your capacity. So we are quite confident about the medium term visibility and the medium term demand that we believe that technology presents itself. So we are building our capacity, we are building our talent, we are making our investments on that belief.
Okay.
Right? And that belief is core to who we are. And within that, whether the deal comes together or it comes as a series of smaller ones, does not materially change our approach or our belief in it.
No, I heard you saying that some of the large clients are looking at scenarios, and as we go in the medium term, how does a tech company prepare for those scenarios?
You mean how do we prepare?
Yeah,
for
because
scenarios?
if they are looking at worst case or neutral case or a good one, your deal also will vary for that, and so that brings in some bit of uncertainty of how it's going to pan out or how they're going to shift out. I'm talking with respect to Europe, where I think this scenario analysis is playing out.
Actually, it's a very, very nice question. So, see, what matters to us and where the changes are two different. If a customer is not sure about what technology adoption to do, if there are a multitude of technologies and we are not sure which direction it will go or whether it will move forward or not, that introduces a significantly higher level of uncertainty for us.
Yeah.
Whereas if the direction of technology change is well known, the speed of that shift is not such a big factor in our own strategy and our own decision making. So we need to run it optimally. We would like to manage our capacity very tightly to demand. But as you know, we run very little liabilities other than the capacity that we carry.
Yeah.
So even if you miss on that estimation, so we always try to stay a bit leaning forward. And maybe we are over invested. And if you miss, then we will be able to anyway tighten and bring it back up in a quarter or two. So there is no significant risk that is introduced. There might be some timing risk of when the demand comes and where the capacity is. That's on the downward cycle. On the upward cycle also, we are conservative. So we are not trying to predict it upfront and massively invest it or very quickly grab capacity so that we can participate in the immediate wave that is there. You would have seen us, even when some changes happen, we are more systematic about how we build our talent or how we build our capacity. And that might mean that we might miss out some of the easy wins in that upcycle.
Yeah.
But overall, I believe that our model is a more resilient model and it's a more valuable model because it minimizes disruption at the enterprise level. And so that's true on the upcycle. And on the down cycle, yeah, maybe we might end up with a bit of excess capacity for a quarter, 2 quarters, 3 quarters. That doesn't matter too much. It will correct itself automatically.
No, I was looking at your deal wins, $8.1 billion TCV in this quarter. But what struck me was the fact that between 1 million and 20 million, you had the maximum wins, 150 and 100. The number of clients remain the same. And you mentioned somewhere in your commentary that the maximum wins between 1 and 20 million is coming from non-US.
No. I think you're mixing two things. This is not about deal wins. This is about the client metrics.
Yes.
Client. So
and,
there was
and leading to the cross-currency headwind.
Yeah,
which is coming.
that's right. So on the client metrics, there was a question asked of me that why are client metrics in I think the 5 million range flattish? Are we seeing that? What I said was that at the lower end of our client pyramid, the impact of cross-currency volatility is a lot higher because in emerging markets and in non-US markets, our client sizes are smaller than on an average. So the pyramid, as it were, has got greater non-US participation on the lower end of it, and the dollar has gained against almost all currency. So in those markets, though our business might have remained stable with the customer, like when reported in dollars, it looks as if it has fallen. So that line remaining stable, the number of customers in that range, is not because there is no growth, but because of the cross currency effect. So that's the point that I was trying to explain. That
how do you manage that kind of thing? Because that is a very broad bottom of the pyramid for you, right? In that sense.
Yeah. So our stance has been that we want to stay relevant to our customers wherever they are in the world, and we don't necessarily actively manage for reported dollar risk on the client portfolio. To some extent, from an economic perspective, also, anyway, we pay dividends in INR terms. So reported dollar is a convenience measure rather than a strategic measure. So we're not overreacting to it. However, it is important to keep that in mind, because once we see significant depreciation, we need to start and asking ourselves what is the business model and what else is behind that depreciation. Is that depreciation driven by significant inflation in that currency? In which case, we should get the price point inflation that should be justifiable. So it's a bit complex in the sense that what do we do about it? In the short term, we are focused on, if you are my customer, and as long as you're giving me the same business, I don't keep coming to you every time the currency that you're dealing with changes. Maybe after a year or 6 months, I might come and tell you that my cost structure is different, your revenue is being impacted by it. But we'll cross that bridge when we come to it. Dollar strength is a problem for everybody. So for us, it has benefits. It has a problem. The way I see it is, we are 50% exposed to the US. So it's in balance. It's not a bad place to be.
Looking at the macros, that's a question which no one can answer with certainty. But given the kind of outlook you have and the kind of exposure you have to various geographies, which is the geography which is looking much more vulnerable today compared to what maybe at the start of the year?
I think Europe by far is.
But you did very well in Europe in Q1.
That's the point. And so macro, our business are interrelated but not directly, what should I say, very tightly linked. Europe, I see, if you think about this whole talk about recession in the two markets, the dynamic in Europe and the dynamic in US is very different. The dynamic in Europe is external, right? And it could change dramatically given the uncertainty in the overall, what should I say, the
energy market, basically.
Energy marketplace, the security situation, the geopolitical situation. Very big swings can happen in an unpredictable way. So the business environment obviously is unsettled in Europe. US, it's more based on something that is doing very well, and the regulator trying to calm it down so that it does not get ahead of itself. That's a very different scenario. Customers have much longer planning cycles, and even if capital cost moves significantly, it does not necessarily change the real economy that much. The European uncertainty affects the real economy. The US uncertainty has a much more limited impact on the real economy.
Does it bring opportunities as well for you?
Both, yes, absolutely. So on the European side, as I said, as clients try to position themselves for all possibilities, we are typically there to help them on both sides of their equation. They want to transform, they want to de-risk, they want to become more efficient. All of that, we have solutions for that. On the US side, as customers prepare to introduce some amount of variability into their cost base, as they prepare to introduce some amount of flex in their partnerships, I think our business model lends itself nicely to that.
Is it fair to say that the manufacturing segment in the European market is the sore point at this point in time because of the uncertainty with respect to gas and energy which is coming in, Germany in particular?
Yeah, absolutely. I think that's a very good, a very fair point. That this time around, the uncertainty is going to be maximum and start from the manufacturing side, because whether it is energy or whether it is supply chain disruptions, both are going to impact the manufacturing sector first, and then onwards we will see the impact to the rest of the economy. So yes, manufacturing, especially in Europe, is going to be challenged, and we need to keep a close watch on it.
What is the kind of exposure that you have to manufacturing and maybe Germany?
Inside Europe, our exposure to manufacturing is in line with our overall manufacturing, which is less than 10% of our revenue. So Europe is 15% of revenue. Out of that,
1.5%.
Yeah, 1.5% or less is
Okay.
Europe manufacturing.
Germany?
Germany itself is about a third of Europe.
Okay.
Right. So that's the size of the market. Slightly, maybe about a quarter of Europe for us, and that's where but the German economy is a resilient economy, right? I mean, they have nothing else other than
there are X factors which will determine how the economy moves around, right?
So the German problem is a P&L problem. Balance sheet is very strong.
Yeah.
There are other economies where the balance sheet is in a problem. So we'll see.
What about the supply side issues? Been talking about it for last 4 or 5 quarters that there have been, and now you're saying that it's easing. In what sense it is easing?
In many ways, there were two big drivers in this industry. One, that while we hired significantly in 2021, many parts of the industry did not hire in 21, as the initial reaction to the pandemic was to reduce hiring. And so that is in FY21, calendar year 20, and then early part of FY21. As the demand came up and the spurt in demand happened, that lack of capacity resulted in significantly elevated churn at all levels. People, because if you have not created fresh capacity from campuses, you are essentially left with having to pull from others. On top of it, the capital markets were so loose that they were pumping money into many startups who were also pulling capacity out of the system. Now that part of it has cooled. 6 months back itself, it had started cooling. So that demand pull is off the table. And we have hired significantly, and others have also hired through FY22. So the supply side is also easing up. So fresh capacity into the system is a lot more. The incremental demand from outside the industry, the direct industry, is a lot less. So both of it comes together to ease the supply side pressure. And that is what you will see in this falling attrition numbers.
You added somewhere around 9,800 employees in the quarter. But if you look at half year number, 35,000 you added in fresh hires. Net hiring was only 24,000, which means that the lateral retrenchment or attrition has been high, and you're not being able to get a pause.
That's not the way to think about it. We hired more than we expanded our total hiring by about 20% in FY22 against a revenue growth of about 15%. That capacity is being made available. So the organic talent development is backfilling the attrition, right? Okay. And we are not relying as much on lateral hiring to backfill the attrition. And that is likely to continue.
So how is the utilization levels looking like? Because that's a number which you don't mention much, but if you look at traditionally the normalized utilization level, we must be below that, and
well
you
below that.
well below that. And how much time will you take to go back to the normalized utilization level of say 75-80% work?
So the first impact, of course, is, as I said, backfilling attrition from inside. That automatically will work on the utilization levels. Other is our reliance on subcontractors and reducing that reliance and working on it. But what will be the right utilization, or rather, when will we get back to the utilization, depends a combination of how this attrition reduces, how travel restrictions ease up, and mobility of talent, etc. So we'll have to wait and see. But essentially, we've taken a forward call that we will load up on the basis and ride out the utilization risk and wait for that capacity to get absorbed.
There must be internal targets of when do you want to go back to that same level to get the same efficiency back into the system?
Not very quantified, but it will be fair to assume that next year, that is FY24, will be a lot increased focus on getting back to our historical operating lines.
Rajesh, in your address yesterday as well, and I think in the analyst call also, you spoke about some of the transformation deal in the utility space, which is transformation in nature, like portability of customers and others. Are you seeing this trend of utilities adopting the transformation deal picking up? You've done it in a couple of countries in the Europe. Do you see that happening in other regions as well?
It is happening a lot because the natural monopoly status is being taken away, and the grids, etc., are only being left, but the customer facing end of it is going away from being a natural monopoly to being a much more competitive field. So utilities are going through multiple transformations,
especially where their consumer is the end.
So they are going through transformation on the consumer side, where competition is coming in. They are going through massive transformation on the generation side, where they are having to be prepared for multiple sources, and consumers having a choice and an opinion on what kind of source that they want to buy from. And they're also going through massive transformation in having to support consumers who are simultaneously producers as well as consumers. This whole idea that I want to have a solar panel and I will sell into the grid when I want to, and I will consume from the grid. So it suddenly becomes a two-way traffic at every point of the node, rather than a one-way traffic.
That's picked up in India as well, right?
That's picked up in India.
Do you see a big opportunity in India as well for that?
Yeah, India market is more complex, but what the government is trying to directionally do to pull the distribution or the grid level at a regulated level, they're in fact trying to introduce competition at the grid level also, but they're trying to increase the competition at the consumer level. So the level of competition that we see in, let's say, in Australia or Europe is different, but it will come. I was recently being shown an app in Europe where consumer prices vary by the hour, and given the huge spike in energy prices, people are actually choosing when to run their laundry load, because they can actually pick what the timing is.
So dynamic pricing during the
dynamic prices through the day at a consumer level, and where consumer action is being driven by that. So that's a very sophisticated market. Right? We will get there, but we are currently in a phase of cleaning up the structure of the industry, getting the government entities, corporatizing the government entities, bringing some amount of that in. Already we are seeing the ability to buy green power off the grid. Right, in most states it's available. So choice is coming, right? So wherever green power is available, we buy green from the grid. So you are seeing that coming in India. Typically in India, it takes time to start up, but once it gets started up, the pace of adoption is quite rapid. So let's see how it plays out.
I wanted to finally touch upon Quartz blockchain, because you did couple of deals. You got 2 deals, I think, and you operationalized one, if I'm not wrong, in this quarter. How is that working? And what kind of potential do you see in that blockchain? And which are the industry specific where you see specific edge cases where you can easily go and implement that kind of blockchain?
Okay, I'm not the expert on it, so I'll try to answer a
Yeah.
part of it, but I don't have much in depth to be able to talk about which industry. What we're seeing is its adoption is significantly increasing. We have invested in twofold. One is we have invested in our banking product suite by integrating it into the core of the banking product so that it will support it out of the box, as it were. But also we have invested in creating what we call Quartz, which is essentially a development and a management layer that allows for a heterogeneous technology at the bottom back end of the blockchain. So it doesn't matter whether you're using Hyperledger or something else, we can actually support it. And the applications can be built on top rather than being technology dependent. And that's been always our focus on how do you stay technology agnostic rather than. So both the adoption of blockchain technologies in various aspects like smart contracts, asset management, even areas like the golden copy in corporate actions. We are seeing a lot of adoption that is coming through, and our focus is supporting that as well as building this Quartz as a layer on top, so that the execution layer can be agnostic to the underlying technology layers. But while some amount of hype around it might cool down in the current environment, the adoption is actually increasing velocity. So the technology adoption will be quite.
And you see across regions that happening, or specific to some regions now?
I am not in a position. Actually, the early ones that we saw were in most unexpected areas. Middle East was a adopter. We have not participated, but Latin America has been an early adopter. So some of the immature markets actually experimented with it more initially. Now the developed markets are also catching up.
Rajesh, it's a pleasure talking to you, and we hope to speak to you next quarter as well to get in depth into the sector. Thank you very much for joining us on BQ Prime.
My pleasure always. Thank you.